Hey everyone, I hope you're doing well and staying safe during this time. If you're new here, welcome to the channel. Like I said, thank you so much for checking me out. If you haven't done so, please make sure to hit that subscribe button just right below the video. Cool, thank you so much. I really do appreciate it. And if you're returning, welcome back. Thanks again for your support. I truly do appreciate having you here.
Too many gaps. Why the SEC is looking to update insider trading rules. The rules around insider trading seem simple. Corporate insiders can't turn a profit or dodge a loss on their stocks while they have pertinent information that regular investors don't know. But one exception offers too much of a loophole, critics say. It's called the safe harbor defense, and it all comes down to timing. It's possible for a fishy-looking transaction to comply with the current rules if the insider locked in the trade before obtaining the material, non-public information. But, as an explainer from the law firm Wilkie Farr & Gallagher notes, there is growing suspicion among enforcement authorities and financial and legal experts that the plans are being abused to obscure more informed insider trading. Now Securities and Exchange Commission Chair Gary Gensler is looking to tighten the loophole, as he discussed in a new interview for Influencers with Andy Serwer. There was something put in place about 20 years ago, he says of the current rules. We came on board and thought, there's too many gaps in this area. There is currently no federal law that specifically bans insider trading, which has left the SEC and the Department of Justice to police the issue using overall general securities fraud laws. The SEC's authority in the area grows from Rule 10b-5, which goes all the way back to the Securities Exchange Act of 1934. In 2000, the rules around insider trading were expanded with Rule 10b-5-1 and Rule 10b-5-2, which cemented the phrase material non-public information into the public lexicon. Gensler's proposed changes, which would update the 2000 rules, wouldn't remove the safe harbor defense entirely. Currently, a trade is allowed if the particulars of the transaction were agreed to in advance and the executive in question doesn't have the power to change the order in the interim. But it would strengthen disclosure requirements. The proposal would add a series of new conditions for allowing insiders to make this defense, and it would add disclosure requirements around corporate buybacks, with more details in quarterly reports. The rules would allow regulators to more closely scrutinize the trades with provisions like a cooling-off period for trades and a new requirement that executives sign written certifications as they enter into timed stock trading plans and other restrictions. These proposed amendments aim to address critical gaps in the SEC's insider trading regime and to help shareholders understand when and how insiders are trading in securities for which they may at times have material non-public information, the SEC says. We are taking it up in both ways. Insider trading has become a front-burner issue for the SEC in recent weeks after a recent Wall Street Journal report that the SEC is looking into whether recent sales by both Tesla, DSLA, CEO Elon Musk and his brother Kimball violated insider trading rules. Gensler declined to confirm whether the SEC is investigating the Musk trades. I'm not going to be able to comment, he said even before Yahoo Finance's Andy Serwer finished a question. But he described insider trading as a key priority for his agency. We're taking it up in both ways, Gensler said of both rule changes and also enforcement of the current rules. This comes down to trust in our capital markets and trust that there's a level playing field, that when you're in the markets, that somebody doesn't have an information advantage from material non-public information. The new rules are still under consideration and open for public comment until April 1st. After that, according to the SEC's rulemaking process, the Commission will consider the public's input and then potentially move towards adoption. SEC Chair: 4 areas of market plumbing under review 1 year after meme stock craze. More than a year since an explosion in trading of GameStop, GME, upended the stock market and heralded a new phenomenon of so-called meme stocks, the Securities and Exchange Commission continues to take a close look at flaws in the market exposed during that fateful January, SEC Chair Gary Gensler told Yahoo Finance in a new interview. Gensler, who took over at the agency last April, outlined 4 areas of the market under review in light of the GameStop saga: the pace of settling a trade once it's completed, transparency and short selling, overall market structure, and gamification. In the middle of that January, he says, a number of online brokers said we can't let the retail public access the market. That access to the market is so fundamental, adds Gensler, who spoke to Yahoo Finance editor-in-chief Andy Serwer on March 2. The first fix under consideration concerns the basic plumbing of the market, Gensler says. Specifically, the SEC wants to address how long it takes for money to move, also known as a trade settlement period. The SEC proposed a set of rule changes last month that includes a reduction of the settlement period for most stock trades from 2 business days after the trade to 1. By cutting down the duration of outstanding trades, the agency will reduce liquidity risks in securities transactions, it said in a statement about the rule changes. Shortening the settlement cycle lowers the risk in the system, Gensler tells Yahoo Finance. As the old saying goes, time is money. Right now, if you do a trade on a Monday, you don't move the money or the stock until Wednesday, he says. You shorten it to Tuesday, less risk. Shares in GameStop rose dramatically over the course of a few days in January 2021, driven in part by discussion on a now famous Reddit thread called r/Wall Street Bets. In response, online trading app Robinhood suspended buying of GameStop and other hot stocks, eliciting anger from traders and members of Congress. Robinhood said it took the action due to minimum capital requirements that it must deposit with clearing houses, which it says became too onerous amid the high-volume trading. Addressing another area of concern noted by Gensler, a rule change proposed by the SEC last month would bring greater transparency to short selling, in which a trader aims to make money off an anticipated decline in a stock's price by borrowing shares, selling them at market value, and pocketing the difference in value when the shares are returned. Short selling played a significant role in the initial uptick of trading interest in GameStop. Identifying short positions in GameStop taken by hedge funds, small investors sought to force them to abandon their position and further buoy the stock. Outlining a third area under review, Gensler said the agency is examining the overall market structure, with a specific focus on payment for order flow, whereby platforms like Robinhood accept smaller price improvement for traders in exchange for higher payments from the market makers that fulfill the trades. Looking at really the equity market structure itself and payment for order flow, and the dark pools of capital that are flowing without transparency, he adds. That's a major project. Finally, the SEC is examining gamification on stock trading platforms that can induce user engagement through prompts, icons, and other features, Gensler said. Speaking to a House committee last May, Gensler highlighted the use of predictive data analytics that allow apps to analyze the success of particular behavioral prompts and modify them as needed. If we watch a movie that a streaming app recommends and don't like it, we might lose a couple of hours of our evening, Gensler told the committee. If a fitness app nudges us to exercise, that's probably a good thing. Following the wrong prompt on a trading app, however, could have a substantial effect on a saver's financial position, he added.
I'm your guy. I will keep you posted. I'm your advocate. I'll be back on a daily basis, usually multiple times per day, with these videos to keep you updated with everything going on. So, I hope you enjoyed the video. If you haven't done so, make sure to hit that subscribe button. Feel free to share any of my videos with your friends, family, social media, or anybody who may care to listen. Thanks so much for your continued support. I'm always here for you. I want to help you through this time. So thank you so much for continuing to choose me. Enjoy your day, stay safe, and I'll catch you again probably in a couple hours. Thanks, everybody. See you later.